Okay, this is our second mini lecture on Chapter 7, and now we're going to be talking about computing costs using 4 inventory costing methods. When we were covering this in the last video, page 2 of our notes, the reason it was easy to calculate the cost of goods sold is because the inventory cost, what we paid for it, remained constant at $10. But what if that's not the case? What if, for example, you sell pens and you begin by buying these pens at 10 cents a piece, perhaps at Sam's Club. And then you find that those pens are on sale at Viking Office Supplies for only 8 cents. So you buy a bunch of boxes, and the boxes look the same as the boxes that you paid 10 cents for. You just paid less for them. It's got the same UPC code on it. And then you find another supplier, Quill Office Products, and they want your business, so they're willing to sell them to you for 5 cents a piece. So you buy even more boxes. When you sell a pen, how do you know whether it's the pen that you paid 10 cents for, or 8 cents for, or 5 cents for? Well, if it wasn't a pen, if it was something that that was unique, and you could tell what you paid for it easily, you might just use the actual cost, and that's called the specific identification method. This individually identifies and records the cost of each item sold as the cost of goods sold. In other words, what you actually paid for it. This method requires accountants to keep track of the purchase cost of each item. And it's mostly used for items that are expensive and unique. So a car has a VIN number, so you can actually know what you paid for that by looking that up on the invoice. Or jewelers, antique dealers, art dealers, you know what you paid for each item because they're unique and easily identifiable. And so the amount you use for this entry is easy. You just use the actual cost. But what if we go back to our example where we're talking about pens? And you've got some pens that you paid 8 cents for, some you paid 5 cents for, and some you paid 10 cents for. And the boxes all look the same. When your clerks restock the inventory, how do they know which boxes they're grabbing? How do you know what to use in your journal entry? And is it worth a great deal of accuracy when we're talking about items that are uniform and very low in value? Probably not. It might be easier to just make one of these assumptions. And I want to tell you now that the method that you choose is up to management and their accountant. Any of these 3 methods are acceptable. With the first method, this mimics reality. The assumption is the first things that you bought are the first things that you sold. So in our example, you would sell the 10-cent pens first, and that's the amount you would use for this journal entry. And then when you finish selling all the 10-cent pens, you'd sell the 8-cent, and eventually the nickel pens. First in, first out. If you want to think of something who's actually stocked that way and actually is sold in that way, think of milk as an example. Grocery stores rotate the milk stock. When new milk comes in, they push the older milk to the front for us to buy and put the new milk toward the back. Now, if you're like me, you know that little secret, so you reach toward the back to get the milk that will last longer. But the intention is that you'll sell the older milk first. The first things that came in are the first that are sold. The second option for us is the last in, first out method. And this method doesn't seem to make sense. It assumes that the inventory costs flow out in the opposite of the order they're received. The last items that you bought are the first that are sold, which seems impossible. Except if you think about items that are sold in piles, like sand and road salt and coal. You can't reach under and sell the old road salt first. You have to sell whatever's on top. But remember, this is the accountant's and management's choice. The real flow of goods doesn't have to match last in, first out. Now we're going to be talking in a little bit about the effect of that inventory method choice on taxes and why it was first developed. It doesn't seem to make sense at first, but the reason is that it was developed is that in times of rising prices, last in, first out gives you the lowest gross profit and net income and therefore the lowest taxes. It's not acceptable in most countries. It's one of those things that is not acceptable under international standards, but we still use it in the United States. With the third method, what we're saying is don't simply average 10 cents, 8 cents, and 5 cents, add them together and divide by 3. Do a weighted average. Multiply the quantity that you bought at each and then divide. We'll show you how it works in just a moment. Okay, so the first step in any inventory problem is to make a chart. And by chart, you don't have to do this part. So I'm just going to cover this up for now because I don't want that to confuse things even further. The first step is to make a chart using that cost of goods sold equation. You take the beginning inventory, and this is done, by the way, for each item that you own. You take the beginning inventory in units, you multiply by what you paid for those items to get the total cost. And then you add in each purchase in chronological order. The number of units times the unit cost equals the total cost. And finally, you add down the number of units, that gives you the number of units available for sale, and then the dollar value of those units, that gives you the cost of goods available for sale. So with regard to this t-shirt product line, there were 50 t-shirts that we could have sold, and when we bought them, they cost us $410. If we know we sold 35 and we have 15 left, what's the amount that we should show as the cost of goods sold on our income statement and the ending inventory on our balance sheet? In other words, there's the cost of goods sold, there's the ending inventory. That's what this chapter is about, finding those two numbers. So first, let's use the specific identification method. Let's say that we know exactly what we sold. We sold 5 units from the beginning inventory. Well, we paid 7 for those, so we multiply that out, and this journal entry would be made for 35. Then we sold 20 units from the October 3rd purchase. Well, we purchased 30, but we only sold 20, so we multiply 20 times 8. That equals 160. Then we sold 10 items from the October 5th purchase. That was all that we bought, and they were $10 a piece. So 10 times 10 is 100. When we add that all up, that gives us the cost of goods sold for the 35 items as $295. Now, we could figure out the ending inventory, what's left, by figuring that, well, we didn't sell 5 of those and we didn't sell 10 of those, and multiply out. But it might be easier. What if we just take the cost of goods available to be sold and subtract out the cost of what we did sell? That will give us our ending inventory. And there's another way to calculate it right there. With the Fifo method, what we're saying is what you had purchased first will be sold first. So we're going to sell from the top down. If we sold 35 units, we're going to sell the beginning inventory and then another 25 of these. So we'll write down here October 1st, we're going to sell those 10 that we paid 7 for. And then to add up to 35, we're going to sell 25 of those 30 units that we paid $8 for. 25 times $8 is $200. Add $70 plus $200, and that will give you $270 as the cost of goods sold. To find out the cost of what's left, take the cost of all the goods that were available for sale, $410, and then subtract out the cost of what you did sell. That will give you the cost of what's left, or ending inventory. And that same calculation is there to the right. The next method is the Lifo method. And with this method, it's the opposite of FIFO. We sell from the last goods we bought and work backwards. So if we sold 35 units, then we sold the October 5th purchase first. 10 units at $10 a piece is $100. And then to add up to a total of 35 units in all, we sold 25 of these 30 that we paid $8 a piece for. And that comes to $200. $100 plus $200 is a total of $300. That was the cost of what we sold, the cost of those 35 units. Now what's the cost of what's left? Our ending inventory? We'll take the cost of all the goods available to be sold, subtract out the cost of what we sold, and that will give us the cost of what's left, $110. And there's that calculation right there. Now the final method, and this is the easiest method, but for some reason it's the one that students often struggle with on tests. We take the dollar value of goods available for sale, $410, and divide by the number of units available for sale, 50 units, and that gives us $8.20 average cost per unit. 410 divided by 50 is $8.20 average cost per unit. Just multiply that by the units sold. That will give you the cost of goods sold, $287, and then take the cost of all the goods available that you could have sold, $410, subtract out the cost of what you did sell, $287, and that gives you the ending inventory, $123. Now I'm going to stop our mini lecture here, and we'll pick up with the tax consequences and effect on net income in our next mini lecture.